welcome to our Bullish on Business webinar series. This is our first video of 2018, and we hope the year has treated you well, probably better than what the Jaguars and Vikings are feeling. But be that as it may, we wish you a very happy Super Bowl and hope your team comes out on top. Big themes so far for this year. I'll start with interest rates. The 10-year rate is up to almost 2.65 as of today's taping. 30-year is about 291. 90-day Treasury bills about 143. So on the 10-year, we're back to last year's highs that we hit right around February, March time frame before rates kind of fell off, closer to the end of the year. That continues to be a theme because that typically translates into probably better returns for financial stocks. It puts pressure on some of our higher yielding investments such as REITs. I'm a believer it's the rate of change and not just the nominal change in interest rates that makes a difference. And so far, I think if the Fed can kind of take it easy on lifting rates, maybe this won't put a kibosh on where we go for the year. So I think interest rates is a number one theme, and you can kind of see how your positions have responded with the increase in interest rates. As of today, the government is shut down. So if you are wanting to get some forms from the IRS or get a mortgage through a rural lending group, you might be in trouble, but the market is kind of shrugging it off to this point, and we're continuing our bull run. So the second theme to discuss is crude oil. Crude, as of today's taping, is about $63.50. We've been as high as probably 64 and change on the year, so we're within striking distance there. If you pull the technicals of crude up on the chart, it looks like we're kind of building a little bit of a base here, and my suspicion is we'll probably take a couple runs at 65 to get over there. But really, from the chart standpoint, it looks like crude could have an extended run to the upside. Now, that's the technicals. Fundamentals are, it appears, more and more of the U.S. Shale producers, which have become the swing producers really for the planet, are coming online, and I think you'll see probably oil prices, and this is a big range, between, say, $60 and $75 a barrel for most of the year, unless something strange happens and the market gets flooded. One thing that appears to be happening in a bigger economic picture is world demand for oil really doesn't appear to be slowing down that much. Now, I know some technophiles here want to say, things are changing with electric vehicles, etc. That's true, but what also is happening is in the emerging markets, which we have put more and more money into, the emerging middle classes all want a car, and typically in some of these burgeoning economies such as Brazil, China, and India, even Turkey, people cannot afford to have a hybrid car. Me, myself, I cannot afford to have a hybrid car either. So I've stuck with the traditional gasoline model and will just kind of grind it out as long as I can. But we think that's very positive. Other trends that we think this is the time to be checking on, biotech. I think the front end of a lot of biotech pipelines and healthcare pipelines will be fitted out via merger and acquisition, as opposed to maybe some of these larger companies doing the work themselves in the lab. So if you've got clients that are looking for, where will some of the growth be, if they're worried that, people are going to quit buying iPhones at $1,000 a pop, or that how many more people can get on Amazon and shop, some of the growth you may want to look in the biotech area, because even today there were two, pretty large buyouts announced, and it appears in healthcare they're going to get their drug pipeline via acquisition as opposed to making discoveries. I think we will also start to see the fruits of the tax overhaul come to bear. Apple had a huge announcement about a week and a half ago. They were going to bring back $350 billion here in the U.S. I think initially on earnings calls you see companies taking charges, but I think the net effect is going to be pretty substantial in a good way. We see so far people are bringing back cash, giving employees bonuses or raises, helping to fund unfunded pension plans, as well as have come in with them capital projects. One stock that continues to be in the headlines for all the wrong reasons is General Electric. My colleague here, Ben, used to be a quasi-employee of GE through another entity, and GE, this is, I think, a repeat of 1990s, hit at 1580 today. Wow, on the downside that there might be some corporate governance issues here, but a real warning sign to me was their inability to get their arms around and get a handle on what their balance sheet liability was with the life insurance company sale. Life insurance is probably one of the oldest businesses on earth, not to mention what the oldest business is, by the way. And actuarial tables have been around for almost millennia, and if they couldn't understand how much risk they had there, that does bring up the specter. Maybe they were not as operationally efficient as we thought. But we do like energy, this year, financials. We think within the biotech space, which should be a bright spot for your more aggressive clients. Also, in a big way, international. We think emerging markets will probably do better because there's higher risk, and we like developed Europe and developed Japan. With a couple words there. One, the specter in the Far East has been what's going to go on with North Korea. It appears, as of the date of this taping, there's been a little bit of a thaw to the relationship. I think next month we'll be up there for the Olympics, and Ben and I are going to the DMZ, and we'll tape live. No, just kidding. But that's helped buoy Far Eastern markets, as that appears that maybe the guy there is getting his head screwed on straight. As well as in Europe, Great Britain, now that the Brexit appears to be gaining, rolling along, there hasn't been widespread fallout there that we thought. The pound is remarkably strong against the dollar, almost so much so I can't hardly believe it. The main British stock we track in some of our portfolios is Diageo. It's like $1 or $2 off of all-time high. So obviously the Brexit has not, at this point, crippled the British economy as some people were theorizing. With that said, we continue to watch our REITs and our fixed income positions like a hawk because of the rate increase, as I said, to kind of open up this call. We will continue to do that. We do see breakouts in many energy stocks. On the tech space, I think 2018 will be more of a bet on the Internet of Things, maybe as opposed to some individual names. I mentioned Apple briefly, but it does appear the stock has kind of plateaued here, the 170 to 179 range. The naysayers are saying there's too much cost in the iPhone, and people have kind of quit just buying new ones to buy new ones. But companies like Texas Instruments that really supply the guts of some of these Amazon Alexa and Google Home tools have seen that business take off, and I think we'll continue to see that. I do think that's a trend that's going to be there. One thing I would also say, materials have done surprisingly well this year, which would be kind of more of a global growth story. So when you look at that, if you want to look at indexes or what have you, I would tend to agree that's been kind of a pleasant surprise. We will keep in touch in February, and till then, if you have any questions, send me an email. You know how to reach me, and keep your eye on the ball. Hello, welcome to this Super Bowl edition investment lineup changes for 2018. I hope all the Philadelphia Eagles and New England Patriot fans are on cloud nine heading into the Super Bowl in a brief fortnight. For those of you who haven't got onto the dynasty of the Patriots bandwagon and hate them, the fact that I am going on to videotape that will last forever has probably put the curse on Tom Brady and Bill Belichick and company, and that I'm on the Patriots bandwagon. With that said, we'll go through the main themes of what's going on in the investment lineups that we have for 2018, and Burns and Alex will put the accompanying spreadsheets together for you. In a big picture, what you'll notice is we are moving more and more of our asset allocation to the international markets. If you attended to the Charlotte event, you heard allocations there recommended all the way up to 50% for your most aggressive clients. We are not quite in that camp, but mostly in our model portfolios, you will see allocations ranging probably anywhere from 8% all the way up to just north of 20, with a good mix between developed market allocations as well as emerging markets. Primarily what we've used is a combination of exchange traded funds, mainly as placeholders first, so we did a little bit more due diligence on where we wanted to be. In smaller portfolios, we've used a lot of the Virtus foreign opportunities, as that had a good European exposure and emerging market both in one ticket. For actively managed emerging markets, we've used a lot of the Oppenheimer Emerging Market Fund. We've also added a couple other foreign investment options in there to go along with the two funds I mentioned. Specifically, Japan, we have continued to use the index EWJ from the iShares. Did that because I think foreign ops was a little bit light on Japan, didn't like it. We feel like we need to have some Japanese exposure, so we have used that index and it's done pretty well. Also, what you will see is our allocation to the US dollar index has been going down, and in some portfolios totally eliminated. Really don't have a good explanation on why the dollar has weakened so much against the Eurozone and the British pound specifically, but it has. I suspect this might be some of the real fallout that's occurred because of Trump being president, and that people have a little bit less faith in the greenback for whatever reason. But so we've pared back there in a U.S. dollar long exposure. Other changes that you will see, we've been using the Principal Preferred Stock Fund. I think it's PPSIX is the symbol. Mainly we like this product because they have exposure to the $1,000 preferred varieties as opposed to just $25 preferreds. There is a lot of academic data to support the $1,000 preferreds perform a little bit better in an up rate environment. Also, one of the areas we've kind of pressed our exposure to has been the Nuveen closed-end mortgage fund, symbol JLS. It will unwind and mature at the end of 2019. The fund paid out a pretty unprecedented capital gain in December, and it's held up better than most fixed income instruments in the rate increases that we've seen since Christmas. Also, what you'll notice is we've continued to have exposure to the Blackstone Mortgage REIT as the main REIT horse of what we've used, symbol BXMT. Even though it's down year to date, the performance has been quite a bit better than the NAREIT index. I think some of that has to do to the reasonable levels of leverage in that product, and it's still spitting out a pretty good rate of return on distributions. Also, for a kind of non-typical product, we've used the TPG lending product. TSLX is the symbol. It's publicly traded. The increase in rates has it's taken a little hit to the NAV there, but also if you need yield, that's one of the places you're going to have to look. As you go through our portfolios, starting with the MDG model that we use, which is different than Ameriprise's, you'll see we are kind of piling a little bit more money into the indexes. Question we get often is, how long can this last? And in an effort that we think rising tides will lift all boats, it's also an opportunity maybe to pile some money into fewer positions, in that when it's time to use stop orders or put some protection on the portfolio, it's going to be easier to do with fewer positions. So that's basically kind of where we're going for the moment to protect ourselves, especially on the growth side that has seen so much of a run. And you'll notice from our allocation standpoint, we've tended to drift a little bit more aggressive than what we've been in the past. Not overly so, but definitely in that wheelhouse. We typically, in our balanced portfolio, which we call our ETF Mini, it can be used for smaller accounts. I think we're down to about 12 positions there. and it's very well mixed between stocks and non-stocks. It's about 50-50 in that respect. It's had a pretty good run for the last 12 months. Our most aggressive models, we have a Vanguard All ETF. We are overweight there in the energy space, as well as upperweight consumer staples, discretionary, and healthcare and financials. Financials, healthcare, and energy are our big overweights there. Underweight utilities in a big way, and we're kind of market weight on the tech side and consumer staples and discretionaries. Our most aggressive model is the growth, and that is has done very well. Obviously, better than what I would have even expected. We're up to probably about 15 to 20 positions there. Greater influence on the international market. We've had a lot of materials in that space. These are typically all individual stocks with a couple indexes, one being for silver, one being the Eurozone, and one being a community bank index. So the QABA was in a couple models for a long time. It didn't do much, but then I think with the tax changes, that's been a one that's done a little bit better here since year end. Our protector model, this is where we go for kind of our more conservative clients. It's about 67.5 fixed income, about 32.5% stocks, which we use all indexes, and we're cruising along there at about a little bit less than 8% returns for our people over the last 12 months. So basically, we like the protector model. It's held up well, and it's kind of the opposite of most portfolios in that almost 70% is in fixed income. So at one point there was 80, and we can go as high as 80 here with 20% in something else, but we're kind of down to just a little bit under 70% in the fixed income model. As I stated, also we kind of revamped the income model to bring the yield up to just over 4%, right at 4% is the yield there. So those are kind of the main bread and butter horses that we have. I will say on some individual stock positions, we are kind of now looking at profit-taking mode, and we'll probably do so at least through July or August. I think we'll have some ups and downs in the market, but my feeling is we probably will be a little bit higher at the end of the year than we are now. But definitely, we'll take profits where we can find them in some of the individual names and keep piling into fewer positions, index a little bit to make it easier to protect the portfolio as we get into the back half of 2018. Look forward to seeing you all at our next conference. Hope you have a great first half of 2018. And remember, I think it's the year of the monkey or the rooster or the pig, maybe. Have a great year.